What's up, guys? Welcome back to the channel. This is from Fed Chair Bulgard. Bulgard. This guy. He's one of the Fed chairs. There's like 12 of them, all these different Federal Reserve banks all around the country. And his quote is this: "I don't think there's anything on the scale of the housing bubble or the internet bubble right now. The only candidate is bonds. I'm not counting that, I guess, because that's us." So guys, it doesn't count, all right? So there's no recession because we changed the definition of it, and there's no bond bubble because it's us. Yeah, so bonds are a triple threat to your capital. Doug Case is very clear on this. You've got currency risk, okay? So as the currency's inflating, bonds are play on the currency. They're a promise to pay you currency units at a later point in time. You have interest rate risk. So as you buy a bond today for, let's say, 2.8% on a 10-year treasury bill, if interest rates rise, which likely in the future they will, we've been in a 40-year period of falling interest rates, we'll probably go to a 40-year period or some sort of period of rising interest rates. Maybe not 40 years, but some sort of period of rising interest rates. So you have interest rate risk, and then you have default risk. Like if somebody defaults on it, even if it's the US government, if they come out and they have like new leadership and they go, look, we can't pay this, all right? And there's a very big case for why they couldn't pay this. Like the US federal government is $31 trillion in debt. They take in tax receipts of $3 trillion. Currently, they're spending about $4 trillion. If the interest rates rise to, let's say, 10%, so that would be the inflation rate, like their stated inflation rate. I don't quite believe that, but let's say that we go with their stated inflation rate. The interest payments on the debt is $3.1 trillion, not counting their spending, $4 trillion, which means at 3.1, they take in tax receipts of 3. They're bankrupt. They're negative 100 billion. It's done, okay? So at some point in time, that's what's going to happen. Whether they do that honestly by just saying, look, we're defaulting, all right? Or they do that dishonestly by just inflating the currency, making 30 trillion like nothing. Like, we could do that too, right? That's typically what these empires tend to do. So bonds are something that you do not want to be in. And so the typical 40-60 portfolio, you've ever heard of the 60-40 portfolio? You got 40% in bonds, 60% in equities. That's garbage, and your financial advisor is totally lying to you. If he's got you in those assets, if he's got you in bonds at this point in time, that is insane and crazy. Now, with that said, when we see the next downturn in equities, we always see a rise in T-bill buying, okay? Because large institutions like pension funds, teachers unions, fire and police, large insurance companies, Harvard Endowment, and every other university endowment fund, they have regulations on what they can do as managers. Like they've got to be maybe 60-40. They've got to be 10% in bonds. They've got to be 50% in bonds, whatever the rules are of that particular fund. However, if you own a treasury bill that's getting you 2.8% interest and the inflation is 9.1, and that continues. Right now we're in a weird thing. It's August of 2022 where people think that the inflation is just transitory, like it's gonna stop at some point in time. Well, if it doesn't, it'll only be a year or two, maybe 3 from now when people go, oh, inflation's 9%, oh, inflation's 9.5, inflation's 9.7, inflation's 10.5, uh-oh. And what's gonna happen is they're guaranteeing you to give you less money back, all right? You're getting a real negative yield. That money, that cash, and we don't know how much it is, but we know it's well into the trillions, is going to move. And so us as investors, we want to figure out, okay, where is that money going to move to? We want to anticipate where that's going to go. And it's probably likely going to go to commodities. That's oil, gas, silver, gold, copper, possibly cryptocurrencies. I mean, it looks like they're deeming Bitcoin a commodity. So it's possible that's really on the far side of the speculation curve. But most likely, this negative yielding debt is just going to move, and it's just going to move somewhere. And we want to anticipate that. So we want to be in assets that are cheap, that are not sexy, that people don't want to be in, and that are not, woke enough to be in. We want to be there, right? Because at the end of the day, reality is going to hit, and reality is going to hit like a ton of bricks. And when it hits, we want to be sitting over there, like sipping a Mai Tai, being like, yeah, we were here early. Like we were here so early, people were making fun of us, but we were here early. And all that cash is just going to flood in and take the assets that we've already purchased and send them to the moon. And then at that point, we want to look at the environment and go like, okay, what's cheap now? US equities might be cheap now, right? Like, so at that point, we want, when the crowd starts to come in and we get that pump, we want to start getting out of the trade. But for the moment, I mean, for the next year or two, this could take up to 5 years. I mean, this could take a lot. These are long, big cycles. This is a 50-year cycle. Like, this is a big, big period of time. We want to anticipate where that cash is going to go. So if your financial guy is like, oh yeah, you want to be 40% in bonds and 60% in equities, fire him. Get rid of him. You don't need him. Okay. You want to reach out to me? Hit me down in the comments below. Travis at Onsite. That's the other channel. You guys check out the other channel, Onsite Trav. But no, the new email, trav@lightcapital.com. No, that's not it either. Man. Well, guys, thank you for checking out the end of the video. It's travis@lightcapital.com. It's all in the show notes below. Hit this video a like if you enjoyed it. Share it with a friend. And I'll see you guys down in the comments. Peace.